Hey, it's tax time, and you may have got your tax returns done already. You may not have, but I'm sure one thing you're probably thinking about is how you reduce your tax bill next year. Certainly, tax planning is an ongoing topic of interest to myself and my clients. So I wanted to give you an overview of the most common tax strategies that we use for our clients, so that you have a framework to look at tax planning that you're currently doing or considering doing. Without further ado, there are three general categories of tax strategies that I see used most often. There's timing strategies, there's income shifting strategies, and there are tax incentive strategies. I'm going to go over each one of them kind of at 30,000 feet level, give you a couple examples, and then move on our way. We've talked a little about income or timing strategies, shifting income from the present period to the future. The most common way that people do that is through a retirement plan of some type or a deferral, a salary deferral plan. So a 457 plan, which is a deferred compensation plan, a 401H plan, a 401K plan, a 501C plan, a simple IRA, an IRA, a SEP plan, a solo 401K plan. These are all examples of income deferral strategies where you push income from the current year down the road. As you might have picked up by the list that I've given you, there's a ton of deferred comp plans out there. And if you haven't looked at these lately, to either implement one for your business or assess whether the current plan you have in place is ideal, you should, because quite honestly, there's quite a few plans out there and a huge variance in how much you can defer and under what circumstances. Personally, as I said in my 12-month rule, I'm not the hugest fan of kicking income taxes down the road, but there's certain times where you want to use a timing strategy. The other part of that is, how do you defer expenses, or how do you bring expenses from future periods into the current period? I talked a little bit about that in the 12-month rule video. If you haven't seen that, basically you're prepaying things as a cash paid taxpayer to bring expenses into the current year. But let's go on to the second category, general category, and that's entity shifting. So entity shifting, or income shifting between entities, is where you have a person or an entity and you're basically taking income and you're pushing it from yourself to them, or you're taking expenses and you're taking it off of their plate and putting them onto your plate. So when I mean an individual, an example of an individual I hear all the time mentioned is hire your kids or hired your retired parents. Of course, if you're at a 25, 30, 35% tax bracket and they're at a 10% bracket, the differential between the two, 25 versus 10, is a 15% tax savings. And certainly, if you're supporting your children, say they're still at home, or if you're supporting your parents, they're retired, you are going to save money because you're basically, paying for things in a cheaper fashion. But the devil's in the details. You can't just say, hey, let's just write our kids a check out of the business without them earning that check. So, a lot of times I hear these income shifting strategies out there without any attention to the detail on which they have to be implemented. So, a word of warning if you're doing that, or if you're considering doing that, it's just, it can save you money, it can save you a lot of money, but there are some strings attached to it. Let's talk about an entity shift. Okay, if it's not an individual, an entity shift, most common, self-rental of a property. You have an LLC in your business, and you have an LLC for your building. Separate entities. You're taking the income that you normally would pay to yourself in rent and paying it to a separate entity. In that case, your business income oftentimes is subject to self-employment tax of 15%. Rent, royalties, rentals, rent income that you're receiving is not subject to self-employment tax. It's a 15% savings. So there's tons of different ways that shifting income between entities can be advantageous. A lot of people are like, well, I have the right entity. Well, you might be better served by having two entities or three entities. the overarching IRS principle is that you cannot set up income and do income shifting just to avoid taxes. There has to be a legitimate business reason for doing things. So back to paying your kids. You can't, or your kids' wages. You can't just pay them money without them earning that pay. You can't just set up a corporation to reduce your income in one versus the other. There has to be a reason, like you're thinking about spinning off the business, to sell it, or you're thinking about spinning off the business to, grow it, and you're raising capital to do that. So oftentimes within the med spa environment, you might have an entity that provides, retail sales might be separated for services that are governed more by a medical director, perfectly normal and legal. You might have a building that you own, separate entities, perfectly legal. So that's, we've talked about two of them. We've talked about timing strategies and income strategies, or income shifting strategies. The last one is tax incentives. So tax incentives are government incentives that are put in place to encourage certain types of behavior. So for example, if you have a 1202 corporation and you sell it, the government allows you to exclude $10 million of capital gains on the sale of that business. Well, why would they do that? Well, a 1202 company is a small business. Well, they're trying to incentivize people starting and growing small businesses. A 1235 deduction. That's a reclassification of income from ordinary income into long-term capital gains. And that's for people that come up with PEN, so PEN income. So a lot of doctors that I work with are PEN holders, and under certain situations, we can reclassify that income into a royalty income, which is taxed at a different rate more advantageously. Last example, most applicable to med spas, is the employee retention credit. Well, that's a retention credit given to employers that kept employees around during COVID. All incentives, single-time write-offs that are put in law to incentivize business owners to act a certain way. So hopefully you've got something out of this video, at least a 30,000-foot view of the different categories of tax planning strategies that are available. Devil's always in the details as far as whether it would be useful for you, how to use them in combination with each other. Anyhow, good luck, and let's work at getting your taxes down next year legally.